I'm Charlotte McLeod with investingnews.com, and here today with me is Keith Weiner, founder and CEO of Monetary Metals. Thank you so much for joining me. Great to have you.
Hey, thanks for having me, Charlotte.
Really good to be speaking with you once again. And of course, I think where we want to start is by checking in on gold, which has risen to all-time highs since our last conversation earlier this year. So I know heading into 2024, you were feeling bullish on gold, but I wanted to ask if the price has moved faster than you expected. Has the trajectory surprised you at all? How are you feeling?
It's funny you say that. So every year we do a annual gold market outlook report, which just given the nature of production schedules and marketing team doing all the graphics and everything else, I typically tend to finish my writing by mid to late January, and then this year I think it hit in March. And so the risk you take is that either whatever move you predict is either already happened and you look like you're not predicting anything. It's like, yeah, it's sunny outside right now. Or the move goes in the opposite direction and you look like an idiot. So this year, I'm trying to remember what I said in terms of, I think we're likely to see 23 as high as 2,300. And we'd almost hit that by the time the report came out, not quite. And obviously now it's over 2,300. So, but I also said, look, this is a bull market. We're not in, that long bear period after the price peaked in August of 2011 through 2018 to 2019 was just endless. And what you should have done if you wanted to trade it at that time was sell the blips. Every time it went up, you should sell. If it really went down, maybe buy a bit more. But that was the way to play that. And now we're not in that market. We're in a buy the dips market, not a sell the blips market. And so I think the fundamentals, both in terms of the macro, are obviously there. The sentiment, certainly in the rest of the world, is there. Not in the U.S. at the moment, and we can talk about that. But I see, essentially endless demand in the East. And I don't think there's a huge amount of selling back to dealers, here in the U.S. and in the Western world. But there's not a lot of appetite to buy at retail or, institutionally, right? That's why there's massive outflows from GLD even. The Western investor, price sensitive, Eastern investor, who is often price sensitive, but not at the moment. We have a model that attempts to calculate, right? So you can use a lot of leverage in the futures market. It gives you 20 to 1 leverage, which means that speculators in the futures market can move the price temporarily, but they can move the price pretty significantly. And so we have a model that attempts to back out what the price effect is on metals, both gold and silver, based on what people are doing in the futures market, to figure out what we call the fundamental price. What would metal be clearing at, today at this moment? And that said, there was a guy named Box, who everybody in data science and statistics would know, who said, all models are wrong. Some models are useful. And so that in that vein, we have a model. But our model can see, whether the fundamentals are higher or lower. And I was on a panel at IPMI conference, International Precious Metals Institute, on was that Saturday, Sunday, something like that. And at that time, the fundamental for silver was just a little over $36, and for gold was about 2,700. So the fundamentals are higher. That means the futures market is a little depressive. People think there's going to be, they're still trained. Pavlov's dogs, Pavlov goes ding, 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 and Pavlov's dogs are trained. Oh yeah, that's right, it's sell the blips. But I don't think we're in that market anymore. And I think those people are going to be burned when continues to march higher. So at the moment, the futures market is pessimistic, pushing the price down. And usually that's short-lived, not always. We'll see, but I think we're in a bull market for both metals.
Okay, I think it's really good to start with that overview there. And there's definitely a lot of points to go into. I'm wondering, if you look at all the drivers of gold right now, what would you pull out as the most significant thing that investors should be watching at the moment? Because I know often in our conversations, you talk about all the noise that's out there and how to filter around that.
I mean, in a certain sense, follow on the monetary metals website the indicators we have, especially the gold basis, which is really telling you what's going on, net of all the different factors. Is India buying? Well, yeah, but India's been buying for, thousands of years. That's why that mercantilist philosophy was developed 500 years ago. They were concerned India was going to get all the gold and they were going to get none. So the idea was you should import gold and export goods. And, protectionism was born. Okay, so India's buying. That's nice. What does that really mean? Outflows from the ETFs, what does that really mean? Well, you can see it in the gold basis. Um, there's a perennial story in the gold. There's two perennial stories in the gold space. One is gold is going from west to east, and two, de-dollarization. So let's talk about those a little bit. Gold sometimes goes from west to east. The problem is by the time the buzz reaches maximum intensity in the west, that trend often is temporarily over. And, my articles over the years, I've looked at that and said, okay, people are still saying this. It's no longer true. Right now, it's definitely true. There are 4 different worlds that are buying gold like it's going out of style. Broadly, China, India, Turkey, and the Arab world. And that brings us to the second theme, de-dollarization. But actually, for 3 of the 4 of them, the reason why they're buying gold is because their local currencies are going down. And they don't trust their governments. They don't trust their currency. They don't trust their banking system. They don't trust their stock markets. And they no longer trust their real estate market in the case of China. So they're buying gold in China, India, Turkey as kind of an anti-government, anti-currency, anti-banking system. Not the dollar, but they're local. And in places where they can't get dollars, because these countries all have capital controls, mind you, they can often get gold where they can't necessarily get dollars, and they do so. Only in the Arab world, where they have a peg, a lot like the GCC nations typically have pegs with the dollar for their local currency. Those pegs, unlike, say, Banana Republic in Latin America, those pegs are stable. I mean, you can look back 30 years and see it's table flat, what it looks like. So they don't have any reason to worry that they're going to wake up tomorrow morning and their currency is going to lose 80% or something. If anybody's buying on fears of de-dollarization, or let's just say mistrust of American monetary policy, it would be the Arab world. The other 3, it's a protest against the rupee, which goes down about 7% a year against the dollar, and the dollar's going down, but it's going down faster than the dollar by 7%. Turkey, even worse, arguably has incipient hyperinflation. China's currency is probably unsustainably high. They do attempt to peg it to the dollar. I think a lot of the Chinese know what's coming, and that's going to be revalued lower. And so they're all trying to protect themselves against their local government and against their local currency.
On the note of China, one of the big stories that I've been seeing around lately is the Chinese central bank pausing its buying in May. So I really wanted to get your take on that in light of what you've been mentioning now, and especially because we've talked previously and you've warned about, how you shouldn't necessarily pay attention to these famous buyer type of narratives. So interested to hear your thoughts.
Yeah, there's a number one, whether China's buying or whether China's not buying, it's gold moving from one corner to another, doesn't necessarily predict price. And for that matter, it doesn't tell you whether the rest of the market is dumping on China's bid or whether China is lifting the rest of the world's offer. Number 2, if you believe that, if you believe all the statistics that come out of China as to what they're doing or not doing in anything related to finance or population or, planning or growth or GDP or any economic statistics, I have a bridge in Guangdong to sell you. So, it's widely believed, widely understood they're playing their own game. Whether they actually stop buying or whether they double down right now is anybody's guess, but the data out of there is at best murky, anyways. So I have no idea, no opinion on that.
Okay. Good to hear about that a little bit though. So you've been talking about the West versus East divide when it comes to gold, and I thought we should take a look over at the West as well, just because we did recently have the Fed's recent meeting where they left rates unchanged, I think, as everyone expected. And it seems that they've been able to keep rates higher for much longer than people expected. So what's your take on that? Why do you think that's been able to happen?
So the real danger of rising rates is you force the marginal borrower into default and bankruptcy. And not that the Fed cares about the marginal borrower, but they care about the banks. And when people start defaulting and businesses start defaulting on loans, and bigger, corporations start defaulting on bonds, that at some point is going to hurt the banking system because they're the holder of, of a lot of this stuff. And what I think has been going on, and if you look at the spread between junk bonds and treasury bonds, that spread, I haven't looked, I could be embarrassing myself. I haven't looked in the last few days, but hasn't really blown out as you'd expect. And so I can only suspect that there's some other way that they have of either buying those bonds, parking them on the Fed's balance sheet, which they've given themselves authority to do, or there's some other subsidy or some sort of other bailout or something that so far the zombie borrowers, right? So on the Monetary Metals podcast, we had something called Zombie Month, which was before the rate hikes, and looking at zombie corporations. And a zombie corporation is defined as their profits are less than their expense, the interest expense. And it's something like 20% of all the debt out there was zombie debt before the interest rate hikes. And then we took the Fed funds rate from essentially 0 to essentially 5.5%. And along the way, there'd be all those zombies are obviously in deeper trouble than they were before, and a whole bunch of other companies that hadn't been zombie at those rates were suddenly rendered into zombies by such an enormous move in interest rates. And so far, all's quiet on the Western Front. So what are they doing on the back end? I don't know. I think when I was on your show earlier, I talked about that the regulators have given the insurance companies green light to buy this, junk bonds without reserving the capital against it that they normally should. And so, it could be regulatory forbearance. It could be wink, wink, nudge, nudge. It could be the Fed's buying some of it or some combination of all the above. But so far, they've managed to, proactively anticipate where the dike is going to spring holes. And then, they have 100 kids out there plugging the holes in the dike with their fingers. And so far, they've gotten away with it. So, and then downstream of credit are things like the stock market and GDP and employment, and those numbers look benign. So everyone says, okay, well, the Fed should stay higher for longer. I think I've said on your show several times, zero interest rates cause many harms. If one were willing to ignore all of those harms and one cared only about one thing, which is the consumer price index, one should want lower interest rates, not higher interest rates. So, I'll give an example. COVID lockdown destroyed a lot of companies, especially related to, let's say, shipping, logistics, warehousing, trucking, et cetera. A lot of companies are wiped out because, they can't go for 6 months without revenues. So those companies are done, and that capacity is lost. And then, you have unlock, and then it's created a whiplash effect. Suddenly there's enormous demand for all this stuff. Suppose you're one of the companies who survived, and now, you see the opportunity, the demand is back to what it had been, but, capacity isn't there anymore. So you'd like to borrow money and buy a whole bunch of trucks or buy some more ships or build some more warehouse space or some more dock space or whatever, a terminal that, for shipping that you want to build. And you suddenly find the interest rate's much higher. Well, now the opportunity has to be even that much bigger. The profits have to be even that much fatter before it justifies at whatever rate you're paying. So, and if the Fed funds rate is 5.5, you might be paying 8%, whereas previously you were paying 3 or 2.5. Well, the profit has to be that much fatter at 8%. And so the Fed, and the higher the Fed pushes the interest rate, the fatter the profit has to be in order to justify the investment. So the Fed thinks that they're fighting inflation with this, but actually they're preventing capacity from being created or recreated. And the higher they push it, the more they prevent productive capacity. All that said, obviously there's a lot of other deflationary forces going on. And, the stimulus of all the COVID-free monies, I think is wearing off. And I think that's where we're at in the cycle. But, timing is very hard to predict on these things.
Right. I think it does help, though, to go through those examples. So thank you for that. And on the note of debt and interest rates, I just want to check my notes here because I saw a headline where Janet Yellen essentially was saying, yeah, high rates are a problem for debt, but if the debt can be stabilized, we'll be in a reasonable place. And when I read that, I was thinking, well, really, is there any chance that the debt can be stabilized? So I was thinking to get your thoughts on that as well.
I'm one of those annoying people that says, okay, wait a minute. What does stabilized mean exactly? Does that mean that the Fed is going to, or the Treasury is going to give subsidies to the debtors? Does that mean the Fed is going to buy a lot of that debt to prop up its price? What exactly does that mean? Because if you're running a business that generates, I don't know, let's say 4% return on capital, which totally made sense when you could borrow at 3%, and now your cost of capital is 8%. I don't know what stable means other than liquidation, destruction, wipeout, ruin, bankruptcy, layoffs, and ultimately the capital has to be repriced much lower and get into the hands of somebody else who can afford it at 8% interest rates. Um, so I don't know what stabilization means, and nothing the Fed does creates a long-term stability. I mean, that's the promise. That's a bogus, counterfeit promise. What they do is they extend and pretend. They put pennies in the fuse box. I mean, there's a million analogies for it, but everything is about, okay, the person gets overtired, so you give him caffeine instead of sleep. What he needs is sleep, but you're trying to stabilize his wakefulness. You don't let him sleep, you give him caffeine. What do you do when the caffeine wears off? Well, you give him cocaine. What do you do when the cocaine wears off? You give him, methamphetamines. What do you do when that wears off? I mean, eventually, it gets worse and worse and worse until the patient collapses in a coma. And that's what the Fed does. So will they stabilize it? Will they do something that people will temporarily concede? Oh, that's stability. Yeah, the Fed succeeded. I mean, they have a lot of tricks up. They have a lot of aces up their sleeve, more than you would think. So very very hard to bet against them. Very hard to say, okay, this is the moment when all the Fed stuff fails. They take their sleep at the switch, and final things blow up. Maybe, but maybe they keep it going for years more.
It is certainly very tricky what they're doing there. And I think on that note, I would ask about the 2% inflation target. And, if you had to give the Fed a grade or a rating on their efforts to tame inflation, how would you approach that? And do you think, I guess, at what point do you think we could see that 2% target fall by the wayside?
Well, if the interest rate is higher, then prices have to be higher. So, in a certain sense, they're going exactly backwards. Imagine you have a downhill skiing race, and there's that guy trudging up the hill, and you say, okay, how would you grade him for his race? Well, he's going in the wrong direction. Again, if the concern is inflation, um, I think the whole thing is an impossible quest, anyways, because the driver of higher prices into and post COVID, the for me drivers are non-monetary. They're completely nothing to do with the Fed or monetary policy or interest rates, and that is lockdown was massively, price risingly, positive, if you want to call that inflation, and then whiplash, right? So we had lockdown, the world settled into a different new normal, and then you abruptly release the lockdown, and then all of a sudden, demand springs back. Then we had trade war and tariffs, you know, uh, toward the end of lockdown, and Biden has kept all the Trump tariffs. But I was going to say, Trump was slapping tariffs. It wasn't just Chinese steel. It was Canadian lumber, it was Scotch whiskey, it was a million and one things. That obviously causes rising prices. Then you have green energy restrictions, where it's either just outright taxes on energy, outright more regulatory compliance, more stuff you have to do, more emissions control stuff or whatever in cars, on and on and on. It's endless. Driving prices up, and and then finally just the march of what I call useless ingredients, when the regulators force companies to do something they wouldn't otherwise do. And so I'm here in London right now, and I'm walking along Piccadilly. It's one of the famous roads here, and there's a giant old mansion that's under remodeling construction, it's been under remodeling construction since pre-COVID. Because every time I come to London, I end up walking past that place, and the construction project's still going on. They're nowhere near the finishing touches. The building is still like and looking gutted. So I don't know what they're forcing them to do in terms of dust abatement, historical preservation. I don't know what the issues are, but the cost of that remodel surely is driven to multiples of what it should be. Um, if it was a free market and you just, it's your building, you model it as you wish. And so, if people see the price tag, and I'll just name a number. Let's assume it's 100 million pounds. I have no idea what it is. People are going to look at that number and they're going to say, "Oh, look, the pound has lost its purchasing power. There's been a lot of inflation in the pound." And then, go to the Bank of England and say, "Okay, do something about it." But here, the cost is so clearly being driven by either environmental or historical society, historical preservation, landmark, whatever they call it here, listed buildings, I think they call them. I'm sure that's a grade 1 or grade 2 listed building. So you have to preserve the history, you have to preserve the facade, or you completely tear down the interior structure, preserving that facade, and then rebuild the whole thing. And it's like, piece by piece, brick by brick kind of work. Um, and, costs enormously higher. And people will say the pound lost its purchasing power, to which I would say, no, it didn't. It's just buying things that let's say that, because I don't know what it's going to be. Let's assume it's a hotel, and the hotel has to charge $1,000 a night, given the cost of the renovation. And people look at it and say, look at how much purchasing power the pound has lost. No, it's buying just as much as it did before. It's just that it's not buying it for you. It's buying it for all of the compliance officers and remediation contractors and all historical preservation contractors and all the other people that were doing demo with a toothbrush instead of a jackhammer. They just made it enormously expensive, and I think that only continues. I don't see any appetite for anybody to say enough is enough. Let's stop all this regulatory stuff. The regulations just become more and more and more expensive to comply with, and in every area, whether it's if you're a financial firm, onboarding compliance, anti-money laundering, know your customer, counter financing of terrorism stuff, whether it's food and supply chain tracking, and we want to know every peanut you put in that dish, every cocoa bean, every whatever, where did that come from? Can you prove your supply chain all the way to the farm? All the stuff just adds more and more and more cost, driving prices up and up and up and up. And then people turn to the Fed and say, "Why don't you hike interest rates to try to compensate for this?" Very perverse.
You can definitely see how it all starts to pile on top of each other when you lay it out like that. And okay, so stepping away from this topic and over to silver, I want to make sure that we catch up on silver. I think in our last conversation, I was asking you something like, why wasn't the silver price moving yet? And since then, we've seen it get over $30 per ounce, which caused some excitement. But during that last time we were talking, you were saying how a lot of silver demand is really driven by the wage earning class. And these people are, of course, under pressure due to inflation and things like that. So I'm wondering about silver getting over 30. How significant is that? For it to take off, do we really need to see these wage earning people have pressures on them lessened?
I mean, not necessarily, but if the wage earners felt less pressure, they certainly could buy more. Of course, other people can step in and buy silver as well, including the capital class. I was just on a panel at IPMI in Orlando, and several of the speakers on my panel were talking about solar demand and all kinds of electronics, all kinds of other demand for silver that's non-monetary, and they're saying that we're in a primary deficit. That is, we are consuming more silver than the mines are producing, and that because silver is $30-something an ounce versus gold at $2,300 an ounce, it doesn't really pay to recycle the silver out of, let's say, solar panels, unless there's some other reason to recycle the solar, either a subsidy or just an outright prohibition on dumping all that glass into the landfills. So if you have to recycle the solar panel for other reasons, then you'll extract the silver. Otherwise, you don't. To which, I didn't get a chance to say it on the panel, but you're giving me a chance now to indulge my, I had a regret that I couldn't say this to the audience there. And that is, if that's true, that silver is being consumed, all the, existing stocks are being bought by industrial users and being consumed and not to be replenished. That's actually an argument that silver is being demonetized, because that's what you expect an industrial commodity to do, to have very low buffer stocks. Industry uses everything that comes out of the mines with people not willing to hold it. That would be a demonetized, X monetary metal. I don't think that's the case. I think there's an awful lot of silver out there that is not coming to market for industrial consumption. But that's the setup to the whole thing. So we're among other things, you could look at monetary metals as conducting experiments in monetary science. We have a marketplace that we've created, and that's our laboratory for experiments. And a setup to this silver bond, I want to talk about. So we do gold and silver leases, and we've done some gold bonds. In all cases, anything gold related, the interest is paid in gold. Anything silver related, interest is paid in silver. We did one platinum lease, and we said to our clients, we're putting up the platinum, by the way, would you like to be paid the interest in gold, or would you like to be paid the interest in platinum? We gave them a choice on that, which we've never done. Like on gold leases, it's gold, and silver leases, it's silver. The response was unanimous. Every last person agreed on the same answer, and that answer was, we want the interest in gold. And I think that one experiment proves decisively that platinum is not money. That platinum is a product of some sort, and it's just like if I have a phone and I'm done with it and I'm going to rent it to you, I don't want to be paid the rental fee in more phones. I want to pay the rental fee in money. And so that proves that gold is money and platinum is an expensive industrial ingredient. Now, could silver become an industrial ingredient? It could. That's what effectively my co-panelists were arguing for. I don't think they realized it. They were just trying to argue for scarcity. I personally think silver retains its monetary characteristics. And so we're super, super excited to do the first silver bond in what I assume to be something like 190 years. And I'm going to explain that, but I just want to get the point out that this is lending silver to a silver producing mine. It's open only to accredited investors, but we could talk about this one openly because we have a compliance path for doing so. So people are lending their silver to a producer of silver, and a producer of silver is going to amortize the loan by pulling the silver out of the ground. So a very simple model. The interest rate's 12% to the investors. And again, it's silver on silver. So if silver is being demonetized, one should expect there wouldn't be any demand for this. And conversely, if there's demand for this, and the size of the bond is 1 million ounces, by the way, so it's not small. If people want to put up 1 million ounces to participate in this, then that shows that, silver is still behaving as money, and people want to put their money up in order to get a money return on money, a silver return on silver. So the reason why I think that this is the first one in likely 180 years is the Coinage Act of 1834 was the United States' first real ploy into demonetizing silver. Britain had done it prior to that. And what that 1834 does is that it undervalues silver as coinage. So silver is worth more on the global market than it is in terms of coins in the U.S. And so then people are going to take the silver out of the U.S., sell it in the world market where, they can make a profit by doing so. So that effectively demonetizes it, at least officially. The farmers and the small craftsmen had silver at that point largely at home. That was their sort of savings. Bigger wealth was gold, and that was in the banks. So I suspect that, and of course the banks, that's where the bond market is. I suspect that financing of industrial ventures like railroads and factories, subsequent to 1834 would have been done in gold, not in silver. And so I think this is probably the first silver bond in something like 190 years. So a historic moment, for silver, and obviously a historic moment for monetary metals. So we're pretty excited.
That is very exciting. And I'll leave a link to the silver bond information in the video description so people can check it out if they want to learn more. And definitely very interesting how you're using your platform to essentially collect data on gold and silver, precious metals. So interesting to hear any more takeaways that you find later on. As we're wrapping up on silver, I think we talked a little bit about gold's price potential in 2024, and I wondered if you have any thoughts on where silver could go heading into the end of the year.
So the fundamental price, as I said, was as of last Friday. I've looked at a few days. It's just been a whirlwind of travel for me. Is in the vicinity of $36. But again, that's just, if you back out the speculators at this moment in time, you'd see something like that. Um, Longer term, yeah, I think it's a bull market because I think it's a bear market in paper currency, right? The monetary metals are just, we price them in paper currency. It's the equivalent of saying how long is the meter stick, and we're using gummy bears and rubber bands to measure the meter stick. The meter stick's getting longer. So it's a bull market in meter sticks. And of course, when you do it that way, when you look at it that way, you realize how absurd that is. But that's how we measure gold, which is the meter stick, using dollars or pounds or euros or whatever. And the thing that we're using as a unit of measure, the dollar itself, let alone all the derivatives like euro and pound and yen and yuan, are falling. And so that looks like a bull market in gold, which everyone's going to be excited about. And they're going to trade the heck out of it, I would suppose. And more power to them. I mean, this is one of those situations. Don't hate the player, hate the Fed for forcing everybody into the game. Which is why we're doing what we're doing, why we're creating gold and silver interest-paying opportunities to try to bring back the use of gold and silver as money and not just simply as a bet to make more dollars in the Fed's casino, which is what it is right now. Yeah.
Yes, makes total sense. And I think we can wrap up here unless you had any final thoughts that you would leave investors with at the moment.
Nothing I can think of at the moment.
Perfect. Okay. Great to have you on as always. Thank you so much for coming on to talk about gold and silver.
My pleasure.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Keith Weiner with Monetary Metals. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.